want to welcome everybody. My name is Ephraim Fishman. I am a partner at LMC. Most of you, probably all of you, know about the firm, know what we're about, but there are a number of people who are watching online who might not know about us, so a short story or to talk about the firm. LMC is a full-service accounting firm. When I say full service, we mean aside from just doing financial statements, tax returns, we also are what we call our trusted advisor to our clients. We get involved in their businesses and get to know them quite well. We also have a fractional CFO department, CAS department, which does bookkeeping for our clients. We also have a family office, which is a part of our business, a growing part of our business. Our office is located a block and a half from here, where we have approximately 120 people. We also have offices in Florida, Connecticut. We have a foreign office in Tirana, Albania, and we also have a number of dedicated people who work for an affiliated company in India. Our business is very diversified. We have clients in a lot of different industries, but we do have a concentration in the real estate area. We also have a concentration in the art area where we handle a lot of art galleries and artists. And the reason why we're here today, another concentration that we have is importers and distributors, where as I said, we started to hear from clients way back when, approximately a year ago during the election cycle, when people were concerned about what was going to happen with the tariffs. And it became more of an issue when Trump got elected, where people were very concerned about what was going to happen. And then most recently, it hit a crescendo when on Independence Day, when everyone was blindsided by the amount of the tariffs, and it's grown since then. It's grown since then, and basically it's mostly what clients want to talk about. There's so many questions that have come up regarding what's going to happen with the tariffs. Do I continue to buy goods from China? Do I place the order? If I'm going to be paying this amount, will I be profitable? Will the stores adjust their pricing that I'm selling to because of this? What's going to happen with my cash flow if I have to pay 145% tariffs? Will I have the funds available? I'll have to deal with the bank to make sure that there's funding available. Being that there's an open to buy and the cost of the goods is so much higher, will there be a diminishing of the amount of goods that are going to be bought? Do I have to reduce the orders that I'm placing overseas? So many questions have come up that we've really got involved with so many different aspects. And it became an area where we said, okay, let's see what we can do. Nobody knows what's going to happen in Washington. It's almost impossible to predict. Every day it's another story. Whether you think that President Trump is a brilliant negotiator or a person who makes decisions on a whim, it really doesn't matter, because we just have to deal with what we're given, and that's what the tariff situation is here. So we put together a very prestigious panel here. We're hoping to get some information. We'll all be able to take some information away that will help us in our purchasing and try to make a little bit of sense out of what's going on. First off, we have Eric Fisch, the Senior Vice President of Consumer and Related National Sector Head for Corporate Banking at HSBC. Next, we have Alan Klestadt, who is a partner in Grunfeld, Desiderio, Lebowitz, Silverman, and Klestadt, and who has devoted most of his practice to developing strategies to maximize sourcing opportunities while minimizing exposure to customs tariffs and import restrictions. And then we have Salvatore Stile II, founder and chairman of Alba Wheels Up International, one of the largest and most prominent custom brokers in America. He is a go-to resource for mainstream media and high-level government officials. With that introduction, I'd like to give the floor to Eric for him to...
Well, it's a pleasure to see everyone and to have this chance. I'm going to speak primarily around foreign exchange, elements of what we're seeing in the market, what the potential implications are for you, and what some hedging strategies are, and what questions you may want to be asking internally to determine if hedging foreign currency risk is the right approach for your company. So I'll start at a very high level around what we're seeing in the markets. So certainly through the beginning of this year, and then in particular after Liberation Day, there was a general weakening of the US dollar against the other major G10 currencies. And so that's continued. So there are multiple factors leading to that. And I think what's particularly interesting about it is in historical terms, when there was disruption in the market and there was potential weakness in different economies, the US dollar was seen as a safe haven. And so the US dollar always benefited from uncertainty, from risk, from large events against other currencies because it is the reserve currency for the world. Given some of the dynamics around trade concerns, currency concerns, and political uncertainty in the US, we've essentially seen a divergence. So what that means is against those major currencies, the US dollar has weakened, and our forecast is continued weakness. Against emerging currencies, it remains strong because of the actions the tariffs will result in. And so, as an example, our historic forecast for the US dollar against the euro was 1.04, and we've adjusted that to 1.15 for year end. The British pound was 1.23, we've adjusted it to 1.32. And then the renminbi has weakened against the dollar. Our forecast is 7.4 for the end of the year. And so this dynamic that's a result of the political uncertainty has caused essentially a change in the way that the US dollar reacts. The currency market, just like all the other markets, can change on a dime, and as policies change, that may change as well. But for the moment, certainly continued weakness in the dollar is what most major banks are expecting. So as we think about that and what the impact of that is potentially on people's businesses, there are a lot of different, and no pun intended, options that people can use, right? So there's hedging and mitigating tools that you can use through banks, and there's a wide range of them, and they all depend on your particular situation, but also your particular point of view. And something to keep in mind as you think about foreign currency in relation to your business is that to the extent you're doing any business overseas whatsoever, either on the sourcing side or the selling side, regardless of what currency you're using, you have foreign currency exposure at some point along the chain. Whether it's your vendor or your vendor's vendor, whomever it is, there's an impact of foreign currency. So to the extent you're paying exclusively in the dollar, if the dollar is moving against those foreign currencies, you're either paying that vendor more or less than you did historically in their local currency, which is what they have to conduct their business in. And so that's something to keep in mind. So we've had more and more companies essentially, and I'm not suggesting since April 2nd, but in general, over recent years, look to take control of that exposure and have a more transparent process internally and look to potentially pay in a foreign currency and then hedge it here. Because quite simply, to the extent the dollar appreciates against emerging currencies, you're paying more dollars to your vendor, you're paying more money to your vendor than you were historically if their currency weakens against the dollar. Now, again, as I mentioned, hedging can take many different forms. The most straightforward is a forward, where you say, I'm booking now, and I'm going to receive this much of this foreign currency at a certain date in the future. Right? That's a very rigid tool that many people use and utilize well. Generally, people do not hedge 100% of their foreign currency risk, because when large events like this happen and people want flexibility, they want to move production, they want to reduce production, whatever it is, that forward, that contract is a contractual obligation. So generally we see people hedging a percentage of their exposure and adjusting that percentage to the extent they see the currency move favorably in their direction. They'll go out and buy more, and then vice versa. If it moves against them, maybe they hedge less. There's also options or puts or collars. These are all tools that can provide some level of insurance and limiting your exposure in general. Ultimately, the goal of foreign currency trading mitigation is to limit your risk and lock in your gross margin or limit your potential pain. The goal here is not to become speculative currency traders. And so to the extent that using this as a mitigation tool for your particular situation or business can improve your assurance of a particular gross margin percentage, this could be a valuable tool for you. I think another interesting thing is that there's some it's really a currency by currency evaluation. There are some countries that have currencies that are not tradable. You cannot book a natural hedge against them. There are non-deliverable products, so there are solutions for it, but it's really country by country. And as companies, especially in the last month, look to explore more sourcing venues, it's important to understand what the dynamics are in that particular country. And even if you're not going to do a hedge, to just be educated about that currency and what the dynamics are that could impact it. Because ultimately, as I will keep emphasizing, even if you're trading in dollars and paying your vendor in dollars, there is an exposure to that country's currency at some point in the process, and that can lead to an impact on how you transact with that vendor. There's always winners and losers in every market, in every dynamic, and in every fluctuation. And so I would be remiss if I didn't point out that I've spoken to quite a few companies who sell in foreign countries and source directly, selling and bring the product in directly to a foreign market. In those cases, the dollar weakening, if you're selling in Europe and the product's traveling directly from where it's being sourced to Europe, and then you're collecting euros, you're now collecting more because the dollar's weakened against the euro. So there are certainly dynamics in the market that are improving. And again, whether it's on the sourcing side or the selling side, there are risk mitigation tools to lock in that benefit potentially. As markets become more volatile, we are seeing clients that have been doing this for long periods of time switching to higher percentages that they are fixing, that they're locking in, and at the same time doing longer tenors. So going further into the future with those currency hedges so that they have more assurance for the future of what the dynamic is. So 2 elements. The last thing I wanted to cover is just maybe some questions to leave you with, to ask yourself about this. And a lot of these, I'm assuming everyone's already asking. But essentially, could a significant change in foreign exchange rates directly impact your business? To the extent we're all importers here, I think it's fairly clear at this point that the answer is probably yes. And then, is there a natural hedge to your business? So what that means is there a dynamic where if a currency weakens against the dollar or strengthens, there's another element to your business, whether it's selling overseas or trading directly in that country, that could create a natural hedge where doing something through the markets doesn't necessarily make sense for your company or add value. The next, I would say, a really important one is, do you and does your company have the bandwidth and the knowledge and the staff to manage a hedging process? So this is something that does add time. It adds a level of complexity to some extent while also adding value. But do you have the appropriate team members to manage that process and keep abreast of it? And then the last thing I would say is this the right tool at this moment to continue to allow you the flexibility as the market continues to change? So the best example would be, if you booked really long dated, dollar RMB forwards, and now you're moving all the way to production out of China, that's going to add a wrinkle to receiving that currency, because it needs to match the dynamics within your business. So hopefully just a helpful entree into foreign exchange and some of the questions that we're hearing from clients, and hopefully you're discussing internally.
So we're going to open up the Q&A if anyone has any follow-up questions, but I do have one question for you, Eric. Yeah. If you have a company, you mentioned that the bandwidth to have the capability of handling it. If you have a company where most of the clients have either a controller or a CFO, would they have the knowledge in order to handle this, or they have to bring in an outsider who has this expertise in the FX trading?
Yeah, a great question. I don't necessarily think you need to bring an outsider or a specialist in. I think whether it's HSBC or any other banking partner can work with you. I think what the key is to establish an internal policy and methodology around it. So what that means is, here's the way we're going to approach foreign exchange trading, and we're going to follow that until we reevaluate it and decide that we're going to adjust it. And if you have that in place, and so as an example, we're going to hedge 50% of our imports on a specific currency, and we're going to go out 30 days, and every 30 days we're then going to book that again and again. So this way, you're not creating stress on this individual to make decisions on a daily basis, because the amount of information that they'll be looking to take in to make those decisions will be overwhelming. Now, what we often find is that we meet with a lot of people on this subject, and they say, I'm not a currency trader, I don't know anything about currency. And so they put in place something simple like I just described, but then as they're immersed in it, they do build that knowledge. And so we'll see someone look at the currency rates and say, I think this is advantageous to my business. I'm going to book 60 and 90 days out. And so all of a sudden, they're developing that knowledge just by going through the cycle and taking advantage of what they see as a change in the market.
And are you seeing customers that never even thought about going into FX with the situation that's happening now suddenly saying, let me look into it?
Yeah, I think, and I'm sure the other panelists will speak to really important other facets of how businesses are reevaluating. And I really do think it's an all of the above approach, where foreign exchange can be one element to mitigate risk around gross margin in conjunction with all these others. So I think as you're looking at the full suite of options available, this should be one. And we're certainly seeing more interest in it on that basis. It's not a solution in itself, but just an element to reduce risk.
All right. Anybody, any questions?
As somebody that's new to FX, I never did anything. Would somebody have to put the entire funds needed to hedge on the side, or a portion of it, or a percentage of it? How does that work?
Yeah, a great question. So it all depends on what your banking relationship looks like. It is a credit product, so that means that the bank is taking credit risk. So to the extent you're working with a bank and have a credit facility, it can be an element as part of that, added on. There are products that are no credit exposure. So a collar, as an example, that's where you limit the risk on both sides. So you may not benefit as much as you would if the currency moves in your favor, but you're going to be protected on the downside, just as an example. And so that doesn't have credit exposure. So it's worth talking to whoever you're working with on the financing side if this is something they can put in place as part of your overall financing, or if you potentially would need to put collateral on the side.
Anybody else? I guess.
So, thanks for the information. Just a snapshot. So let's say you're an importer and you do $1 million a month, whatever. A simple execution of what you discussed is, do you pay as you play? In other words, you have $1 million worth of goods, so you buy that currency at that time? Do you buy it in advance? How do you project in that simple?
Yeah, sure. So I would want to be clear that whatever works for your business is available in the market. So that's the easiest way to describe it. In the plain vanilla case I described, you'd book it for 30 days and you'd have all of that period of 30 days to use it up. And then you do it again and again. Now, there are more flexible options than that, like options, where you either choose to exercise it or you don't. And it's essentially like paying a fee to buy it. But in the example I gave, it's a window.
Thanks.
Yeah. Hey, Gus.
Thank you again. You discussed some specific areas where foreign exchange risk is very hard to mitigate, or simply discussing non-deliverable products. What are the specific areas or geographic areas where foreign exchange risk is the hardest or almost not possible to mitigate?
Yeah. So
Would there be an example that you could provide?
yeah. So there are Chinese renminbi, Indian rupee, Thai baht. These are all examples where there's less flexibility than you would be with a US dollar euro kind of a trade. But there are 170 plus currencies. Each one has its own dynamic. So I wouldn't, first of all, I'm not an expert on each currency or any in particular, but I'd want to sort of encourage you, to the extent there's one in particular, I could get more information for you, but generally, what I'd say generally on all of those is that there's products, synthetic products, where you can still mitigate that risk. It's just, it won't be starting with a US dollar and the end result is receiving that foreign currency. There'd be a step in between.
Thank you, Eric. Appreciate it. Alan, the microphone is all yours.
Let me tell you what I'm not going to talk about. We're not going to do a recap of where all the tariffs stand. I'm not going to go through the list of the different types of tariffs that we're facing, right? You all have a sense. You've got the standard tariffs, right? What we call the MFN book tariff, right? What we've always paid. Okay, we've got, if you're in China, the Section 301 tariffs from the first Trump administration, right? Then we've got the 2 fentanyl tariffs, right? 10 plus 10. Okay, then we've got our reciprocal tariff from China, 125. From everywhere else, another 10. That was as of this morning, right? Unless you're in the automotive sector, in which case everything changed for you yesterday. Okay, and that's the world we all live in, right? From moment to moment, day to day, very difficult to plan, very difficult to be strategic with regard to what you're going to buy, where you're going to buy it, never mind what you're going to sell it for. Okay, so what I am going to talk about today are mitigation strategies. Okay, things we can do to lessen the blow. There are, last week I was saying there are no magic bullets. There really are very, very, very few, if any. So, almost everybody in this room, we're stuck. Okay, we're going to pay these additional tariffs in one form or another. We may, as things change. So a couple of weeks ago, everybody read about the fact that Apple was successful in getting a breakout for a lot of the electronic components. Okay, so the way that worked, it was not company specific. Let me back up again. The first Trump administration, right, the Section 301 tariffs, we had both product specific and company specific exclusions. Okay. Under the current administration, we haven't had so far company-specific exclusions, but we're evolving to product exclusions, okay? So, again, it depends upon the particular tariff that we're talking about. Each one is the subject of a separate, unique framework. So we have what we call 232 tariffs if you're importing items with steel or aluminum in them, okay? And there are breakouts for certain items, certain steel and aluminum items that are eligible for, I want to say, discounted duty rates, depending on whether they incorporate U.S. components, where the steel and the aluminum was smelted, poured, cast. So lots of complexity out there. We're not going to spend time talking about that today because it just makes your head spin. And for a lot of folks here, I don't think it's particularly applicable to your products. But we can talk about it some other time. So duty mitigation strategies at a high level. Brian, are we going to be able to get this up?
We're working on it.
Okay. So we have valuation strategies. I'm going to talk about, I think a lot of this is percolated through the communities. We're going to talk about first sale and agency program as being two primary strategies to reduce the amount of duties being paid. We're going to talk about country of origin strategies, classification reviews, and then some operational strategies using bonded warehouses to defer duty payments, and the issue du jour, DDP, delivered duty paid. We'll talk about it. Okay, so let's jump to it. And you know, it marries nicely with what we were just talking about, because we're talking about cost control. And in the same manner that foreign currency hedging is cost control, right? We're trying to mitigate or control the cost of our products at source level, right? What are we paying for it? And you know, foreign currency is one of those hidden variables that people don't think about. You know, we're always buying in dollars, we're buying FOB, but the business is really happening at a different level. You know, we buy FOB, but we cost LDP or DDP, right? We cost on a landed basis. We add in duty and freight and all the brokerage charges and handling charges to figure out what our first cost really is. But we only talk about the goods in terms of their FOB price, right? And same thing, we're talking about FOB price, we're talking about in terms of dollars, but you know, we all know the business is being done in RMB or in rupees or in baht, whatever it is. So, you know, it's a very timely call out to think about the foreign currency issue. It's hidden in there in the cost of goods sold. Okay. So for customs purposes, and I am first and foremost a customs lawyer, the customs value statute provides for different methods of appraisement, several different methods of appraisement, depending on the structure of the transaction. The primary method is called transaction value. And you know, lawyers, we're caught up in words and the definition. So transaction value is the price paid by the buyer to the seller when the goods are sold for export to the United States, plus certain additional costs if they're not already included in that value. So we take that little statement apart and we talk about price paid or payable, buyer and seller, and sale for export. Okay, these are all different terms of art which open up opportunities. So the first sale program, which is probably the most widely discussed duty saving strategy in today's market, exists where there are back-to-back sales, where the goods are being sold to the importer through a middleman or some type of trading company. And that structure exists more often than not. Even for the most sophisticated importers, we're very often dealing with an entity that has multiple structures, okay, and has got a trading entity which sits on top of the actual production facility. So where we have these kinds of middleman structures, or I'm going to call them sophisticated sales structures, there's an opportunity there to do the first sale. First sale, the concept is we want to get back to the sale from the factory to the middleman, use that as our dutiable basis, as opposed to the sale from the middleman to the importer, okay, which is what we typically pay duty on. So we negotiate FOB, but underneath that FOB price, there's a underlying sale, a factory sale, and that's what we're trying to pay duty on, okay? So first sale allows us to remove the middleman's profit and overhead from the dutiable assessment, okay? Significantly, and what's great about all these duty savings programs is we're not taking money off the table. We're not telling our vendor you're going to make less money if you do first sale. We're also not asking him what your profit is. That's not what first sale is about, okay? As I said, we buy goods FOB, but we land DDP, right? So if we can lower the landed cost of the goods, we've effectively made the vendor's goods less expensive, okay? We've helped him. We've realized a benefit, so has he. So we're not reducing the amount we're paying for the goods, but we're reducing the amount of duty that we pay, okay? We can do this both where the middleman is using a third-party factory, so where he's subcontracting to an independent supplier, and where he owns the factory. So even in a related party transaction where the middleman owns the production facility, there's an opportunity to create a first sale duty savings. Okay. Typical first sale savings. You know, the guys we're doing business with, and it doesn't matter what business you're in, whether you're in apparel, you're in electronics, you're in automotive, you're in food supply, it's the same everywhere, right? There's a cost of doing business. It costs the vendor some amount to turn on the lights, to show up with air conditioning in the office, to pay his staff, okay, to keep abreast of what's in the market, right? He's got an overhead expense, which is on top of whatever it costs to produce the garment or produce the product. Do a lot of work in the apparel sector. So there's always going to be some cost of doing business. When we sit down with the vendors and we start talking about what kind of duty savings can we realize, talking about his overhead and profit, okay, we're typically looking at somewhere in the 15 to 25%. Now, it can be lower depending upon the particular industry you're in, right, and the price point at which your goods are selling. But you think about what it costs you to run your business, how much less expensive can it be to run his business on a percentage basis, right? So when we sit down and start negotiating first sale price, figuring out what we're going to save, you know, sometimes we say, well, it's 5%. No, it's not. It can't be, right? There's nobody in this room who can run his business on a 5% margin. So we know that there's more there, okay? And that's part of what we're looking at as we start to figure out how to implement the program, how to evaluate what we're going to do. You know, what's the return on the investment going to be, right? Big deal. So in that regard, we know if we're buying from China, okay, there's a VAT, and the vendor's recovering the VAT. So right off the bat, we're looking at a 13% savings. We can make the VAT non-dutiable under the first sale program, okay? So we've got the VAT plus his overhead. Now we're getting somewhere, right? So it's stuff we look at and we're able to deconstruct. Great thing about first sale is it takes advantage of a structure that already exists. We're not asking him to change the way he does business. We may tweak certain aspects of the transaction. We may tweak some of the local delivery arrangements to create a proper sale, but for the most part, everything's going to flow the way it does today, right? We don't need to reinvent the wheel. We don't need to tell him he has to do things dramatically different, that he's going to realize a different tax structure or anything of that nature. So first sale works pretty well for all parties involved, okay? It gets a little more complicated where the vendor owns the factory. Where that happens, we have to make sure there's an arm's length transaction, right? We've got to make sure that the transfer price between the related parties satisfies the customs requirements, which are different than the IRS requirements, okay? Essentially, what we have to demonstrate is that the factory is making a profit which is comparable to the parent company's profit on a percentage basis. So if the factory's got a 4% return and the parent's got a 12% return, we have an issue. We have to figure out how to manipulate that price to make it satisfy the customs requirements. But you know, that's, in today's world, there's a lot more flexibility in the market than there was 6 months ago, never mind 6 years ago. So we're able to get things done today that we couldn't necessarily do historically. So even if you looked at first sale and determined that it wasn't worthwhile or that it wasn't manageable because the vendor wouldn't cooperate, and we're at that inflection point, it's time to go back and turn over those old stones again and see if there isn't a new opportunity, okay? So when we're going to go forward with a first sale program, you know, we start at the top. We want to understand who our vendors are, who are the key players, right? Let's get the biggest bang for the buck. Make sure we have a relationship that's going to withstand the process, and project out savings. The critical component is always the documentation, right? The devil's in the details. You know, people say, oh, first sale, easy. I got back-to-back sales. I'll just get an invoice from the factory and we'll be good to go. It's not that simple, okay? You know, customs is not really interested in giving it away. You know, they want the money. So there are a couple of hoops you got to jump through to make sure you qualify. And we want to make sure that whatever we do in terms of duty mitigation is going to withstand scrutiny down the line, right? We're in a, you know, we're at the beginning of a cycle, right? We're in the midst of a transition. So now we're all trying to figure out what the new normal looks like, right? Adjust. We just got the body blow with these tariffs. So we're trying to figure out how to, you know, how to adjust to what looks like the new normal. A few months down the line, customs is going to have adjusted, and they're going to start asking questions. Hey, you're doing business differently than you did it before, or the prices seem to have changed. Duh, okay. So now we want to see that those are the right prices, that that's what you actually paid for the goods, that you valued the goods correctly. So we're going to go through a period in a couple of months where we start to get inquiries from customs. We'll be getting requests for information, right, CF-28s. We'll be getting audit notices. They're going to come knocking on the door, for sure. So anything we do today has to withstand scrutiny tomorrow. So it's not just running out there getting a second invoice. We've got to make sure that the details hold up, right? It's all about the documents. It's all about the details of the documents. Not every structure lends itself to a first sale transaction. There are some vendors who are simply factories. They don't have a middleman structure. They're not interested in running their business that way. Or they've got a related party transaction and we can't kosher the transfer price. We can't make that fall within the U.S. Customs requirements. So plan B, we sit with the vendors, and you know, in today's world, the reality is there are very few pure factory relationships left, right? There are very few guys who are just showing up every day, cutting and sewing, pressing, assembling, okay? They're doing more than that. You know, they're communicating with you. They're providing what I call value-added services. Quality control, logistics support, market research, third-party testing. Okay, they're doing more to enhance the relationship and the product than factories historically did. So there's an opportunity to take these value-added services, which historically were performed by buying agents, okay? It's a concept from the past. You had these large, large service bureaus, basically, in the Far East, folks like Li and Feng, okay, that provided all these services. Well, that business has basically been consumed by most of the vendors. So you don't have the same need for a third-party buying agent that you did 15 or 20 years ago. The vendors are doing those things for you. So what we try to do is we try to unbundle the vendor's price. We're paying for these services, and they're important to us, right? They facilitate the transaction, they add value to the goods that we buy, but they don't necessarily have to be dutiable. So a lot of what we do in customs valuation is we look at form over substance. Okay, like I said with first sale, we're not changing the way they do business, but we're changing the structure of the we're looking at the transaction a little differently. We turn it sideways. Okay, with this agency program that I'm going to talk about, this unbundling, same kind of thing. We're looking at the transaction a little differently. If we take these same services, which are now embedded in the price we pay for the goods, and which are currently dutiable, if we can restructure them, pay them to a third party, they can be non-dutiable. So just to illustrate it very clearly, if you have a product which requires lab testing, okay, for Prop 65, for CPSC, for customer purposes, whatever they want to see, a lab test to see that it satisfies safety standards, it's color fast, whatever it is. If the vendor takes the product, sends it out to a third-party lab, okay, has the lab test performed, sends it to you, and they pay for the test, that testing fee is dutiable. In contrast, if you pay the lab directly for the same service, it's non-dutiable. Right? Basic tenet of customs valuation. All monies paid by the buyer to the seller are dutiable. So our goal, and back to what I said when I started rambling, who's the buyer, who's the seller? Okay? What are we paying for? So non-production related expenses can be non-dutiable if they're paid to third parties and if they're properly documented. So in the agency program, what we try to do is identify these non-production related expenses which can be paid to a third party. Certain expenses are always dutiable. Packing costs, payments for molds and tooling, foreign design fees, always dutiable. Doesn't matter who gets paid for them. Okay? But what we try to do with the agency program is we get the vendor to set up a separate entity, a separate company, which will be their company. They'll own it, they'll run it, but it'll be a real company that'll be responsible to perform these value-added services. So they'll become our primary communication touch point. They're the ones who will keep us posted on production, logistics, quality inspections, sampling, etc. Okay? And we'll start working through this agent. And we'll pay for those services. Historically, Customs has accepted buying agency commissions of anywhere from 3 to 12% of the value of the FOB value of the goods. I'm a conservative guy. I like 10%, particularly when we're dealing with a related party transaction. You want to stay within an accepted range, okay? And I always say, pigs get fat and hogs get slaughtered. There's no reason to be, there's a lot of reason to be overly aggressive. It's just not good business. Okay, so we don't want to get out there and have a problem down the line. So as I said, we'd have the vendor set up a separate agency company. We'd enter into an agency agreement with them, which defines the services they're going to provide. Okay, we're going to pay them. It's their money. They can do whatever they want with the money, except pay it back to the selling company. Okay, so it's like, I think about it, right pocket, left pocket. You know, which pocket you're putting the money in. You just can't combine them into the same pocket. But you can take the funds you make in the agency company and buy yourself real estate, buy yourself a boat, pay for your kids' education, do whatever it is you want to do with it. We don't care. You can also take that agency company and set it up offshore. Doesn't have to be in China. Doesn't have to be in Hong Kong. It can be in Singapore. It can be in the British Virgin Islands. It can be in the Channel Islands, wherever you want it. It can be in Canada. Okay? Again, doesn't matter to us, but it provides the vendor with an opportunity to unbundle his income and to move some of his funds outside of his primary country. So that can be attractive to them from a tax perspective and a financial planning perspective. Okay? Word of caution. Okay? Simply creating a separate invoice for service fees does not work. I get that question a lot. Okay, well just invoice me separately. 2 invoices, we call that double invoicing. That's customs fraud. Okay? So again, simple concept, requires that we do it right so that we live to play another day. Okay? Devil is always in the details. Okay. All right, other strategies. So those are the 2 primary value strategies that we use for most folks who are in consumer products businesses. First sale, agency program. Those are the primary opportunities there. Other opportunities for duty savings, country of origin. Okay? With these reciprocal tariffs, right? China, 125%, the rest of the world, 10%. So if we can shift the origin of our goods from China to Vietnam, Cambodia, Malaysia, Philippines, someplace with a more friendly tariff structure, there's an opportunity for duty savings there. Okay? Tariffs are based on origin, and the rules of origin are complex, sometimes illogical, and there are opportunities there as a result. So if you take materials or components from country A, send them to country B, where they are substantially transformed, word of art, into a new article of commerce, those components lose their identity as a product of country A, and the finished item is considered a product of country B and potentially subject to more beneficial tariff treatment. There are certain components, if you will, which will impact the origin regardless of what else happens. So, for example, if you're dealing with an electronic product, okay, if you have a printed circuit board, Customs in their infinite wisdom has determined that the printed circuit board provides the essence of the functionality of the product. It doesn't matter whether we're talking about a cell phone, a razor, a coffee maker. That PCB is to Customs the end-all and be-all. So you take a PCB which is populated in Taiwan, you put it into a cell phone that you've made in China, you have a Taiwanese phone. Just reporting the news, okay? So that's the rationale they've come up with for that. So, it's crazy, right? We all know that's crazy, but that's where their rulings are. So we can live with that, we can work with that, okay? And we can create duty savings opportunities. Other types of crazy results, if you're in the jewelry business, country of origin of a ring is determined by where the setting is cast. Okay, so you take gold, you pour it in India, create a ring, you bring in diamonds from China, from Central America, you set the ring comes in as a product of India. not the country in which the stone was mined. Totally illogical result, right? The value is all in the stone, but customs has decided that the essence of the item is created by where the casting is made. So, I think two crazy results. You know, we have a little closer to home for garments, right? Garments which are knit to shape, right? If we have panels which are knit to shape in one country and assembled in a second country, the country of knitting remains the country of origin, right? Even though the assembly process is the more skilled process, more skilled operation, okay? So there are, and so, you know, not to belabor the point too long, there are country of origin opportunities. There are anomalies out there which can provide opportunities to do some creative sourcing. In a much more mundane vein, classification, tariff headings, right? We've been using the same tariff headings forever. And if your duty rate has been low, you know, if you're doing an accessory, a consumer product, you've been paying 5%, 3%, 12%, it was fine. That was the cost of doing business. We never thought twice about it. Well, now, there's a reason to think about it again, okay? And we want to go back and look at classifications and say, is that the right classification? Can we get somewhere else which might have an exception, a partial allowance? Okay, what can I do to impact that duty rate? Can I use U.S. components? Okay. I have clients who bring in gardening supplies, all kinds of crazy things. And there is a special duty provision for items which are used for horticultural purposes. It's within Chapter 98 of the tariff schedule. Anything that falls in Chapter 98 is exempted from the fentanyl tariffs and from reciprocal tariffs. So there's an opportunity there for a huge savings if we can get into Chapter 98, into one of the special duty provisions. Okay. Likewise, if we've got U.S. components which we send overseas and assemble into a finished product, the finished product may qualify for Chapter 98 classification, which provides us with a huge opportunity. So we want to look at classification again. Okay. I had a client the other day bringing in some Bluetooth devices. Well, the gift to Apple, the Apple gift, covered a lot of tariff headings, which are now exempted from the tariff, from the reciprocal tariffs, including tariff headings covering certain Bluetooth devices. So there's an opportunity there, okay, that we may be able to take advantage of. My client had a product which involved it was actually a Bluetooth thermometer, okay, with a probe and a hub. And we're able to get the hub, which is the majority of the value of the product, into one of these tariff provisions, into one of these Bluetooth tariff provisions, and we're going to save a substantial amount of money by not paying reciprocal tariffs and the fentanyl tariffs on the hub. And we'll ship it separately and combine them here. So, different ways to look at things. I want to talk briefly. I'm almost done, Ephraim.
Okay.
I'm sorry, I know.
Just want to be cognizant of everyone's time.
I'm going on here. It's a lot to cover.
Sure.
Bonded warehouses. So some other duty-saving strategies that folks have been kicking around, okay? Using bonded warehouses. A bonded customs warehouse allows you to put goods, import goods, enter them into the bonded warehouse without paying duty. So you defer the payment of duty until such time as you withdraw those goods for consumption. The beauty about a bonded warehouse is that when the goods are withdrawn for consumption, you pay duty based on the rate in effect at that time, at the time of withdrawal. So, you know, we all read the papers. You know, Trump and Bessent have said these China tariffs are unsustainable. So we should be seeing a reduction, right? If we don't need the inventory right away, bonded warehouse, defer it, and hopefully in the next not too long period of time, tariff rates come down, we can withdraw, pay duty at the lower rate, and we've realized a substantial duty savings. Okay? Bonded warehouses are very different from foreign trade zones, which is another concept that gets kicked around very often. Okay? The executive orders specifically provide that goods which are entered into a foreign trade zone are attached to the duty rate in effect at the time that they were put into the zone. So putting them into a foreign trade zone does not result in a duty savings, even if the duty rate drops by the time you withdraw the goods from the zone. So bonded warehouse is not the same thing as a foreign trade zone. Okay, very important. Okay.
Went wrong. Please try again.
You ain't kidding. Okay. The last, and Ephraim, just I can't not talk about it. I feel this question, it feels like 24 times a day. Delivered duty paid, DDP, right? It is the issue du jour. So everybody knows what that is, right? The vendor's going to become the importer. He's going to deliver it to us. He's going to take responsibility for the duty. We're going to be off the hook. No, we're not. Okay? So DDP is an Incoterm which provides that the seller assumes all responsibility, risk associated with delivering the goods to a specified point. Okay? Under DDP, the seller is responsible to arrange for transportation and customs clearance. Landed duty paid, LDP, okay, very similar, except the buyer is responsible to transport the goods from the port of clearance to the final destination. Okay, so we become responsible after they've cleared customs. DDP shifts primary tariff responsibility onto the vendor, but it doesn't remove responsibility from the ultimate consignee. The party that's causing the goods to come to the United States, that initiates the transaction, that orders the goods, I don't know how else to say it, is the ultimate consignee. You're in the supply chain. Okay, we can't pretend we're not in the supply chain. And we can't just turn a blind eye to what the vendor is doing. Okay, so it's important for us to confirm that he's doing the transaction correctly, that he's set himself up correctly as an importer, and that the value he's paying duty on is correct. Right? We see lots of DDP transactions where the invoice prices are just, they don't pass the red face test. Okay? You know, it's a closeout, it's this, that, and certainly in today's market, the vendor is going to discount very heavily. We understand that. Okay? But where the DDP price is too good to be true, it's too good to be true. And you have to recognize that, and you can't pretend not to realize something doesn't smell right. That's your obligation as the ultimate consignee. Okay?
Yes, and I just want to add to that, if you don't mind. There's actually been case law where a company in California turned a blind eye to a below market DDP with a vendor they were using, okay, and they had a substantial fine for being part of the transaction of evading the duty. So there's case law on the precedent of this, and this is a very, very big area that a lot of people are not aware of. They think, oh, it's a importer of records responsibility, I'm just a consignee. Especially if you had a importer, if you're the importer and you're buying FOB and now you want to switch it to your factory, I like to make one other caveat, because now there's, and Alan, you could comment on this. If you're gearing and guiding that factory on how to do DDP and giving advice and a little, not having like a wall, so to speak, because they should be doing it on their own, you could be also brought into the questionability of what's going on.
Well, so there's a right way to do DDP, and there are other ways to do DDP. And, part of the issue also becomes not just our liability, but we want to make sure we get the goods on time, right? We want to make sure the goods come through as contracted. So to be an importer, you have to have something called the right to make entry, right? Not everybody can be an importer, right? So you have to have a financial interest in the transaction. What a lot of these guys do is they find some nominal U.S. company. Their cousin Susie has a candy store in Jamaica, and she's got a U.S. company. She says, yeah, you can use my name. So he uses her IRS number. He files the entry, and Customs says, who's this? Who's Susie? We don't have any record of her being an importer. They start to ask questions. The goods get delayed. Goods get held. So we start to incur demurrage. Okay. Now there's back and forth, back and forth. Eventually, Customs wants to see the purchase order from the ultimate consignee. Well, it's 5 times the invoice price of what was declared to Customs. Back and forth. Customs says, you want to clear the goods? First of all, the ultimate consignee has to be the importer, and you have to pay duty on that purchase order price. So we've got storage, we've got duty fees that are beyond anything we ever contemplated, and that great DDP transaction sucks. Okay, I mean, it turns into a disaster. So there are pitfalls to DDP. It has to be thought through a little bit. It's not a free ride.
Thank you, Alan, for a wonderful presentation. Thank you. So with that, Sal, it's all yours.
I'm going to speak today about what Alba does, and it's not by no means to be a sales pitch for Alba, but to show what the best practices are based on our size, our scope, our interaction with other government agencies, customs, invite-only committees, my personal involvement in discussions with the highest level officials in the administration at one time or the other. So what we basically do is we take the laws that are presented in a knowledgeable, high knowledgeable, we have one of the largest number of custom brokers in the country, and we combine that with our talent, our technology, most important, ability to execute so that we could make things as simple as possible for an importer like yourself. What do we do? Okay, so I'm going to give you some examples of what we do for our clients that could be measured or what should be done for any of your customs brokers, okay, as a compare and what should be done. We've been in business for 75 years, and unfortunately during these tough times for most everyone else, this is where we've actually had our largest growth spurt, and that's usually because of our ability to execute quickly, give importers answers that are very unclear to them, and come up with a plan with technologies on how to immediately address their concerns, because my position is that yes, you want to reduce costs, but you also want to prevent costs. And if you could prevent the cost, that could be very substantial, because most importers that I've found that have not prevented costs could be making millions and millions of dollars of errors in their decisions. One example, which Alan just made, was that the foreign trade zone versus the bonded warehouse, there's a caveat that was carved out that if the goods go in, at the sake of discussion, 145%, they're coming out at 145%. Whereas a bonded warehouse, if they go in at 145%, you withdraw them at the duty in effect at that time. I had one of the largest footwear companies last week ask me my advice. I said bonded warehouse. They had 4 other brokers, and the foreign trade zones themselves tell them, no, just do it this way. They followed me. They saved millions because they wouldn't have been able to take the goods out at a lower rate of duty. They would have been stuck at 145% if they were still in effect, and they would have to export all the goods out of the country rather than sell them to a buyer in the U.S. So my point is that the broker you work with must be extremely knowledgeable in the details and the caveats of the law, because there are a lot of portions of the executive orders that actually override other aspects of the customs rules and so forth. And if you're not on top of it, one case between, I believe, April 10th and May 4th, a lot of auto part companies were clearing and paying reciprocal tariffs when they shouldn't have been. So they have to now do supplemental petitions to get the money back and so forth and so on. And that was because the brokers weren't aware of the finite aspect of what to do. So to me, having a good broker is extremely important that has technologies that could help assist with all these numerous laws and give you a high-level understanding of where you are with your import program. So one of the things we did for Alba, for all our clients, when obviously everyone had a meltdown with the 145% to 10%, it was very confusing, okay? We created a chart for an importer in Excel from every single entry they had for the last 12 months, rolling average. We took every tariff number, we said what's exempt, what's going to apply by country, by supplier, by value, and we were able to give them forecasting based on the current new rates of duty for the next month, 2 month, 3 month. Now, as we know, every week the rates of duty are changing sometimes, and there's all these changes. All we have to do is just plug in the new rate, they get their new report, and they have a forecast immediately, and they could base landed cost on that, they could base decisions on that, and that's the speed to market that people need. So it's extremely important. Anyone you work with has those type of systems in place that could be executed fairly quickly. Some brokers that we came across with new clients said, we can't get you that information for maybe another 30 days. Well, at that time, I mean, most people have a bigger issue on their hands because you need that information fairly quickly so that you can plan on your landed cost, your strategy, your sourcing. So one of the things we did, which was extremely differential, and I'm probably one of the few experts in the country that could discuss this, it's a partnership with a company called Trade Verified that we had 2 years ago. We foresaw that customs and the lay of the land was going to be heavy focus on Uyghur, forced labor, and that just doesn't apply to China. China is only probably the 4th country that has most of these exams and WROs, withholding release orders. There's other countries involved, and it goes by a component from China that has to be analyzed if it goes into another component or bill of material into Vietnam, India, anywhere. So what we found is that most companies don't have the wherewithal or the ability, other than getting first-tier information of a PDF, which, quite frankly, is losing more validity daily, because 20% of the cotton I read in when Reuters did an article last February in retailers is forced labor cotton, yet no one's signing a PDF from the supplier saying we have forced labor cotton for 20% of our goods. So, in my opinion, those type of documents and those checks and balances aren't going to be very relied upon in the future, especially for the fact that with a first-tier supplier that has 10 other suppliers, okay, and subcontractors and sourcing, they could change that daily, monthly, and if you do a check today or you send a team in, 30 days from now it could be obsolete. So what we did is we partnered with Trade Verified. We had the exclusive in apparel and footwear because we're one of the largest brokers in the U.S., and they felt that we could penetrate and explain to importers the benefits of this program and how ultimately we could save them hundreds of thousands of dollars, not only in WRO holds. We had an example where we had a release in 3 days versus traditional several months because of the way the technology could gather information and present it into a format that customs could review. And it's been an extremely successful program that I think everyone, especially in this audience, should at least understand the capability and what it could do and how it would help your company. So one of the reasons why we created this program in addition to helping our import clients to reduce costs with personnel doing compliance, which basically you could have 20 people trying to do the same thing as this technology, where now you could bring it down to 5, okay? The customs regulations, and on the customs website, and Alan, you could probably reemphasize, the standard of proof and expectation right now is that at the shipment level, for any shipment that you're bringing in, you must have the ability from raw material, building material. If a guy has 10 subcontractors and he's a first-year supplier, you need to know all of it in order to get a shipment released, okay, if there was a WRO. So if someone's not providing that information, or you can't gather that information, you say they don't want to provide it, Customs is not going to give any credence to that, and you'll either lose the shipment or you'll have a very hard time obtaining it. And if you did obtain it, it'd be several months later, and probably the goods would be devalued or rejected, or you'd have to close them out somewhere else. So that's extremely, extremely important factor that I'm finding out. A lot of importers aren't aware of that standard of responsibility of what they're expected to do. Okay. So when we were talking about the Trade Verify program, what it is basically a very sophisticated program that previously was used by governments throughout the world, Department of Homeland Security. It was used to determine threats to the U.S., fentanyl tracking, very high level analysis, and extremely confidential type of programs. And the way to explain what this program does, to make an analogy, if a lot of people are familiar with the type of 21andMe or the DNA of where your ancestors came from and so forth type thing, this program would be the equivalent of, not only could it tell you where your ancestor came from, but who their neighbors were in that country, okay, where they shopped, what bar they visited, what drinks they ordered, when they went to the market, what they bought, and items and put in their basket. It's to that level of detail, okay? And with that, that provides a history of your supply chain from the raw material, the building material, so that if customs were to ask or have a WRO, or you're supposed to have this information immediately available to provide to them, you could do it. And one example we had, and I think it actually was one of our mutual clients, Alan, we had a client, a new client that came to us because they heard about the technology, and they had about 30 shipments from Guatemala held for a WRO. It was Chinese suspected forced labor material. We were able, at that point in time, to upload, I would say, 400,000 documents, okay? The documents were in Mandarin, they were handwritten, they were all over the place. The software was able to take all this data, reconfigure it, translate it, and put it into a format that, rather than give 400,000 documents to customs, maybe it was, for the sake of discussion, 5,000 documents to customs that were specific on these entries, these containers, and they were able to get a release within 4 days, which is unheard of. And we're probably one of the first in the country to have a release to that magnitude. And how's that benefit us and the Trade Verify program? Well, now it's setting a bar, setting a standard with customs that they know this technology could provide this level at this bar, and that means any other technologies, and there are a few other players out there, okay, that are in this space, not as good, but they're well known for marketing and other purposes, let's just say. They can't do that. These programs could basically say, hey, do a check in the system. This guy may be bad, he may be good, but if you had a WRO or a hold, you're on your own. They can't scrub the documents, they can't upload, so there's no way to assist with the issue. And that's really what I feel is the main differential on this type of technology versus all the other technologies available. And with that, which you can't see, but there's a visual where you could type in a supplier name, and I could go down 10 to 15 levels all the way to raw material and code green, red, concern, and what the concern is and why. We ran this for someone that wasn't our client, but through open source intelligence for one of the largest apparel companies in the country, who is very big on sustainability and adhering to laws. They probably had 30 or 40 people in their compliance department, and we ascertained at the very end where they were getting their raw materials from was alleged forced labor. So it just goes to show that even with the best of teams, it just can't emulate what we call the artificial agent that is working nonstop, reteaching itself and seeking out every possible, alternative and availability of information, whether it be the dark web, Wayback Machine, satellite imagery, and so forth. So that's one thing on the forced labor. But what this also does is it takes the bill of materials with tariff numbers, and we would say that electronics and chips, one of our clients is the largest chip makers in the world, okay? That's far harder to prove traceability than apparel and other sectors that we found. One of the trade verified clients, let's just say, is one of the biggest software companies in the world that start with an M, okay? And they have a very big foundation for the ex-wife of the founder. And they chose this program because apparently in a Surface Book, there's 10,000 different products that come in, and they have to show origin of each material, so forth, not forced labor, this, and this program's able to do that. That just shows the magnitude of what the Trade Verified program does. It's also used for the special programs for Mexico, Canada. Program detected that a importer thought he was able to get the duty-free or reduced tariff out of Mexico. However, the program detected that he wasn't, because his fabric was from China. It overtook the threshold of the regional value content, and it was exempt from that. So another thing the program does is that it could gather information and documents from every party of the supply chain, whether it's on a manual upload basis for those that aren't sophisticated, or it could pull from Dropbox, any type of portal that would have this information. And it basically will take each manufacturer, each process, and let you know if you're missing a document, something that should have been put in there to be scrubbed, so that, again, real-time preventability, that if there was an issue, you know what it is, and they have to upload and so forth. The days of people saying, oh, we don't want you to know who our subcontractors are, this and that. Most of them who are working with the Gaps, American Eagle, those type of companies, they know they got to comply because they're going to be replaced by people that will comply. It's a new world, and you can't have $1 million order held because one of your people are not helping with a WRO. I would say that's correct, Alan?
Yeah, no,
Yeah.
it's that the vendor obstacles are a lot fewer and a lot less sustainable than they were historically. Whether you're talking about pricing or about sourcing, there's a lot more transparency today. There needs to be, because we're all under a lot more pressure, right? From the tariffs, from these forced labor issues. There are a lot more obstacles today to getting goods delivered than there were historically. So there's a need for partners to be partners, to cooperate, and the vendors are the ones who have access to a lot of this information. You want to keep doing business together, we got to work together.
Right. So one of the questions I get all the time is, well, how does this program get all this information? Okay. The first thing I said is, trust me, if they're working on fentanyl and threats to the U.S., it's highly more technical than finding sourcing of apparel manufacturers and chip manufacturers and so forth. So they do it certain ways: proprietary, open source intelligence, black web, dark web, you name it. These guys have a tremendous ability to pull intelligence. One of the things they also do to come up with these risk analysis, because at the end of the day, it's how is this going to all benefit us, right, with all this technology. One thing we do is, which you'll see it on the larger presentation when I send it to you. This is a satellite image in China, and on the left-hand side is an open field with nothing there. It's a Google search. So if you put the coordinates and you say, what's there? Vacant farmland. Our proprietary technology with satellite imagery actually shows you an actual forced labor camp with the towers, the fencing, and right there. We could actually get to the level of seeing probably individuals wearing orange suits, but we felt that was a little bit too over the top, and Trade Verified actually didn't want to risk any of their people in China or satellite companies, because there could be obviously some severe ramifications to that extent. But let's just say we know these are forced labor camps. And from these forced labor camps, we could demonstrate the trade routes to the factories and all the trucks and how everything works, and then show you the connect of the dots. So when you take this on the ground information, when you take documentation, when you take the dark web, you get billions of bits information to make what's called a risk assessment. And this would be the benefit to all importers. And the way we were one of the first to come with the risk assessment is, we said importers are not going to want to go on the program unless they want for a little entertainment to see, what a forced labor camp looks like and all this. They want the end result. So what we did is we created two types of certificates, similar to like a DMB certificate or a UL underwriter. So the certificate would have a score for every shipment, for every supplier, or you could run it once a month, once a week. Many of our clients do it weekly. And what this basically score does, it's from 0 to 1,000. It tells you what score you have for a particular supplier and why. It's not just going to say your score is 650 and you're on your own to find out. It's going to delineate what the score is so that you could go further back into that supplier and say, hey, there's a concern here and we want to address it, because ultimately this could be an issue for us. This report goes directly to your customs attorney for client attorney privilege. Alba does not see it. We don't want to see it. We want it to be between you and the attorney for various reasons. So that's your internal report. You'll find Walmart, TJ Maxx, a lot of companies are coming more involved in the supply chain. Previously, they'd asked for all these PDF certifications. Everyone's signing their life away, which I can't understand why, when half of it's probably in error. So what we did was we created an outbound report where it does not discuss your suppliers, it does not discuss your score. It basically takes key areas which you could modify or include, and in this instance, it would go to a retailer or a stakeholder saying, we were scrubbed by the Trade Verified top program in the world. We found no forced labor, no child labor, no restricted entity list, no this, no that. Here it is. If you need backups that we could redact if you want, if you want us to share your supplies, we can provide that. And it should suffice than giving them 100,000 documents that they're basically gonna not probably go through each one, and they'll probably be obsolete within 30 days anyway. So this has been a big selling point for a lot of our clients who want to obtain new business from retailers and stakeholders and Costco's and those type of people. The programs, it's been a big win. So that's that on the trade technology that could be offered. And for this group, Alba's willing to, with Trade Verified, I spoke to the CEO the other day, we'd be more than happy to give a free scrub at a very high level of your supply chain. All we would need is a tier 1 supplier or two, and we'd give the report, the analysis, and you could kind of get a feel of what's going on. We had clients that were about to use us said, oh, we're clean and this and that. Well, all of a sudden we found some concerning issues with child labor and this and that, and it was a big eye-opener to them, to say the least. So with Alba, and during my presentations, which quite frankly, most of them are impromptu because I never know exactly what audience members are going to be in what sector, so I kind of get a feel for the room and so forth. But I would say most are apparel, accessory, shoe, and maybe electronics here today, or anything outside that scope. Okay, great. So what I like to do is always say, well, Sal didn't have anything so enlightening for me today, if that was the case, so what else is there? So I bring a big value in 2 other areas. And the first one is, everyone I presume knows what a bill of lading is, okay? Ocean bill of lading has your shipper information, your details, POs, marks, numbers, so forth and so on. So would it be safe to say that you wouldn't want your privileged shipment information in the hands of not only your customers, but also your competitors? That I would think that would be a fair assessment, okay? What many people don't realize is that Customs shares all your data and manifest information in the public domain. So that means that if you have a shipment and it's coming from wherever, anyone could go on through a third-party software program and see how much you paid, how many cartons, with the PO's number, who was the shipper, who's the everything. It's an open book. So what we do for our clients is the ability to redact through a confidentiality removal with Customs, so that should anyone go to do a check on, and there'll be a lot of people doing checks now because everyone's scrambling who's getting what where from who with the tariffs, who's going into India, who's going to Vietnam, who's the best in this, so everyone's going to be searching for everyone's suppliers, I assure you. We could redact that. But one of the good things the program could do is it could give the top relationships of you or a competitor that was not redacted. So for the sake of discussion, I ran a public company, American Eagle Outfitters, okay? Not a client of ours, it's public information. And I have their top 10 suppliers and who they're buying from, but better yet, who their suppliers are selling to, which are your competitors. So, and it gives a breakdown of how many shipments they're selling to your competitors. So you may have, thinking you have a special relationship with a supplier, meanwhile he's selling to 3 other of your competitors. And with that, it will give every single shipment, what's being shipped, POs to either you, your competitor, and so forth. So as a courtesy today, Alba Wheels Up will, which is traditionally a $500 charge per year, anyone that wants to contact me, we'll do a scrub, see if you have any of your information in the public domain, and we'll help you remove it so that you don't have to worry about those type of exposures. The last thing I want to mention is I always get from all my clients, every penny counts savings. We have to look everywhere. It's it's tough with the retailers, the tariffs, we get beaten down. We teamed up with a company called Profit Trust several years ago to help our clients with their small parcel and freight audit spend. And what this technology basically does, and I could attest, our clients, in aggregate have saved millions upon millions of dollars. Okay, some as high as $1 million a year, some as low as $20,000 a year. But what the program basically does, as long as we have access to your FedEx, UPS, DHL login, there's a very in-depth scrub of every shipment you've ever had, okay, and it's going to give you two criterions. One, are you overpaying compared to people that are shipping similarly? So that would be what's called rate negotiation. You think you have the best rates, everyone says they have the best rates, but meanwhile, most of the time you don't have the best rates. So when you're paying $15 for that package, your competitors are paying 12 or less and so forth. And there's an aggregate savings that could be extremely substantial. We just did one chocolate company where the savings was $1 million alone, and that's not uncommon. So if you'd like, we could give a complimentary review. So that would be the rate negotiation, where basically you go back to the carrier and say, hey, we're paying too much, we're going to go to UPS, we're going to go to FedEx, we're going to go to DHL. We have to come to some type of discussion on how to address this. The great thing about this technology, you don't have to switch from any vendor, you don't have to switch your warehouse, you don't have to switch your account number, you don't have to switch any of your current IT. All it is keeping everything the same, but paying less. And in one example, for an Alba client this month, they saved $53,000 from the program, okay, with a no-touch, automatic. And each invoice will show a credit directly to their account from FedEx to verify they actually got the $53,000, and it's found money at the end of the day. So I have on my slide, which I could send out to everyone, the QR code for Profit Trust, who for today's purposes said they would extend no obligation review. They'll run all your shipments to show you on FedEx, UPS, what you're spending, what you could be spending, and if there's been any audit errors, which are usually 3 to 5% of your annual spend, from anywhere from 40 more key points, late delivery, mislabeling, whatever it may be. And those on average, I would say on $1 million spend is $50,000 just in pure refunds. Because the reality is, no one's calling to try to collect $5 on a shipment in your office to call UPS. This automatically does it. If you have a lot of volume, you're just going to get a pure credit every month. So I think that's something that's worth, when everyone's concerned about lowering cost, I think that's a layup to at least get a review. And if you have great rates, fine. You have the best. But if you don't, now you know what you got to do. So in general, that's my summary of the logistics space right now in the market. And if anyone's would like to reach out to me directly, I'd be more than happy to also review, again, no obligation, freight rates, air freight, ocean freight. A lot of people think that they have the best rates out there, but there's a lot of caveats in this business. There's a lot of overcharges in this business. There's a lot of people, if you're air freighting, if you don't understand the difference between chargeable weight and actual weight, it could be a very big problem, because that's where I found in my audits that I've done for companies, there's been hundreds of thousands of misbillings, only because people don't understand that volume weight and actual weight on how to calculate it. There's always a discrepancy, usually from that packing list your supplier provide you to what the freight forward is charging, and I've seen differentials anywhere from 5 to 10%. So that's substantial. And there should be protocols and systems in place that if there is a deviation of 5 to 10% from what the packing list says to what you're being billed, someone has to have an order or be accountable for it or remeasure, because it's a rampant issue in our industry that I feel has to be addressed. Thanks.